Thank you so much for watching Trading Day. I'm Amber Canmore. Our trending trade this hour is oil. Let's take a look at the price, trading at the lowest level since 2021. We're now trading with a 65 handle. Just a couple of weeks ago, we were around 80. What's happened? Let's bring in Andy Lippo, president of Lippo Oil Associates. Andy, those growth concerns, I guess they really took hold of the oil market. Help us understand the sudden down move that we've seen.
Good afternoon, Amber. Thanks very much for having me. I think over the last couple of weeks, we've seen crude oil prices decline for a number of reasons. First and foremost, of most note is that the Chinese Purchasing Managers Index contracted for the fourth month in a row, and that was reported over the weekend. Of course, that's cast a bearish pall over the market. At the same time that we're seeing Libyan oil production may be resuming and coming back on the market. And this combined with the end of the summer driving season and the peak oil demand here in the U.S. is also adding to bearish supply-demand dynamics. Of course, when you layer all of this on top of members of OPEC Plus continuing to overproduce beyond their quotas, and even this morning, OPEC itself finally modestly reduced their demand forecast for 2024. It's just continuing to add to selling pressure on the oil market.
So that explains why we're down here. The question, of course, becomes, have we overcorrected for some of those factors, or do you see further downside?
Well, I'm frankly very surprised that we're trading WTI at around $65 per barrel, and I think it is overdone to the downside. We might be seeing today some long liquidation as people try to pick a bottom around a WTI price of $70 a barrel. But at these low prices, what we could expect is further declines in drilling rig usage, as well as lesser investments in North America. But frankly, what we're seeing today is the culmination of investments made in the US and Canada over the last 3 to 5 years that have resulted in record oil production in both countries.
Is there another move by OPEC?
Well, what I think we're going to see is, just like they decided to defer the reinstatement of their production cuts by 2 months till December 1st, I think one only needs to look at the price of Brent and WTI to determine that OPEC is very likely to defer that restoration until the end of the year and possibly through the first quarter of 2025. Brent prices at these levels is certainly not sufficient to maintain any sort of budget discipline in OPEC plus member countries, and so therefore they're going to be continuing to look at the price and deciding on their course of action with those prices.
Chinese growth has been disappointing for some time. Is there anything that can move oil outside of what's going on in China, or is it just the persistent weakness, maybe the acceleration of the weakness that's taking investors by surprise?
Well, beyond China, where we're seeing a significant increase in the number of electric vehicles that are being sold, which reduces the demand for gasoline or reduces the growth forecast. The same thing can be said on the diesel side, where diesel engines are being replaced with other sorts of engines. And with the construction boom slowing down, of course, that impacts on diesel demand, which all means that the oil market really needs to look to India for significant growth over the next couple of years.
I think about, how this ultimately feeds into inflation through gas prices. As we know, it tends to take longer for lower oil prices to show up than higher oil prices at the pumps. But, at what point do you expect to see these lower gas prices?
Well, we've certainly been seeing it over the last few weeks, and I expect here in the United States, where the national average is currently about $3.26 a gallon, we could easily see the national retail average approach $3 a gallon by Halloween. Now, you put that in conjunction with diesel prices being down 80 cents a gallon on a year-over-year basis. Those lower diesel prices flow through to all the goods and services that the consumer is receiving by truck, whether it's at the supermarket or the shopping malls. So this tends to ease the pressure on inflation, but it does take several months to trickle on through.
You mentioned, often, and it's often said, the cure for low commodity prices is low commodity prices, because then the producers pull back. At $70, many of these oil and gas companies, including Canadians, can have a very nice life, can, spit out tons of free cash flow. At 65, does that start to get precarious, or is it even lower at 60? What's the threshold, do you think?
Well, probably these days, with the improvement in efficiency, the threshold is below $60 a barrel. For the Canadian producers, they're certainly happy that we've seen the Trans Mountain expansion come online. The pipeline is currently operating at about 700,000 barrels a day out of a total capacity of 890,000 barrels a day. We'll continue to see the Canadian producers ramp up production to take advantage of that available pipeline egress capacity. Here in the United States, especially in the Permian Basin, drilling is likely to slow down a little bit, as limited by pipeline capacity, not only on the oil side, but on the natural gas side, where natural gas prices are currently near $2 a million BTU. So that has been one of the big constraints in the oil patch here in Texas.